You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
Welcome back to the deep dive. You know, if you spend any time watching financial news, it feels like, well, whiplash. Right. 1 minute, it's all about the next hot stock, the guaranteed 10-bagger. The next, it's panic about a recession.
Yeah, that constant chase for the quick gain, it's everywhere.
But it's the wrong game.
Yeah.
Completely. So today we're diving into something different. It's this blueprint the really successful wealth builders use, thinking in decades.
That's absolutely the core of it.
Yeah.
You know, the timeline you pick, whether you're thinking 6 months out or maybe 30 years out, it just completely changes the kind of investment game you should be playing.
Right.
Most people. They're playing that short game,
Yeah.
subject to all the market noise, the ups and downs.
Yeah.
But the moment you consciously stretch that horizon, say 20, 30 years, the whole thing flips. The math, the psychology.
Okay.
The longer view means potentially much more powerful return, exponentially more powerful, really. But, and it's a big but, you need the patience. You have to handle the volatility that comes with it.
Okay, so let's pin this down. What does thinking in decades actually mean in practice? What are we doing?
It's very deliberate. It means you're essentially buying an outcome that's, say, 30 years away, not trading a price movement that might happen in the next 3 months.
So you ignore the day-to-day stuff.
You actively filter out that short-term noise, because you recognize that the really big shifts, the structural changes, the huge wealth creation, that stuff only really happens through compounding. Patient, relentless compounding.
And compounding, that's where the real magic is, isn't it? People just, I think, underestimate how that growth curve works over really long periods.
They really do. The sources had a great example. Let's say you start with 10 grand.
Yeah.
$10,000. And you get a, pretty achievable 7% return each year.
Right.
After 10 years, you've doubled your money. $20,000. Feels pretty good.
Yeah, that's solid. Nothing wrong with that.
Right. But here's where time becomes your superpower. Let that same investment run for 30 years. So just another decade and a half on top of the first 10. You don't just triple your money. You leap all the way up to over $76,000.
Wow.
That huge jump in the later years. That's compounding. That's the hidden engine.
That's a really powerful difference. Okay, so if we accept the math, we need the mindset. The sources talk about this noise versus signal idea. How do we tell the difference?
Well, noise is what dominates the short term. It's speculation, it's temporary events like geopolitical stuff, maybe a CEO's tweet.
Market emotions, fear and greed.
Exactly. All that stuff. It's random, unpredictable mostly. The signal, though, that's what emerges over decades.
Like the underlying value.
Precisely. Actual productivity growth, real innovation, economies expanding, demographic shifts that you can see coming a mile off. If your horizon is 30 years at a 20% drop in year 7 because of some small recession, that's noise. It just fades into the long-term trend.
That sounds logical, but ignoring a big crash, that's tough psychologically. Is there a real-world example, like an asset that really tested people's resolve?
Oh, the Amazon example is perfect.
Yeah.
And brutal. If you were thinking in decades and bought Amazon way back, say, 1997, you needed nerves of steel, absolute steel.
Because of the dot-com crash?
You had to watch it fall. What, 50%? More.
Yeah.
Then hold on through 2008, the financial crisis. Another massive hit.
And most people seeing half their money gone twice. They'd sell, surely.
Absolutely. That's the panic point for most investors.
Yeah.
But the decade thinker, they weren't just looking at the stock price.
What were they looking at?
The underlying structure. Amazon was building the infrastructure for the future. E-commerce, cloud computing, they were laying the tracks.
The signal.
That was the signal. And the reward for focusing on that, for holding on, returns over, what, 100,000% eventually? That wasn't just a trade. That was patient capital betting on a long-term vision.
Okay, that shift from price swings to structural value is critical. So let's get practical. If you buy into this mindset, what assets actually reward this kind of extreme patience? Where should you look?
Well, equities have to be top of the list. Stocks, they're the most accessible compounder for most people.
But not just any stock, right?
Definitely not. You're not chasing the next hot thing. You need companies with what the sources call strong economic moats.
Economic moats. I like that term. How do you spot one? How do you know it's strong enough to last, say, 30 years?
A moat is basically a durable competitive advantage, something that protects the company's profits from competitors trying to take their lunch.
Like what, specifically?
Well, you look for things like high switching costs, Think about Microsoft's ecosystem for businesses. It's just really hard and expensive to leave once you're in.
Okay, yeah.
Or maybe long-standing brand power like Coca-Cola, built over a century, right?
Yeah.
Or sometimes it's regulations or network effects where the product gets better as more people use it.
Mm-hmm.
These companies might seem kind of boring in the short run.
Yeah, not exciting headlines.
Not at all. But they offer that steady, reliable compounding potential over decades. That's the goal here.
Makes sense. Okay, beyond stocks, real estate, often talked about for long-term wealth. Why does it fit this decade thinking?
It really does, mainly because of leverage. It's one of the few areas where you, as an individual, can control a really large asset, say a $500,000 property, with a much smaller amount of your own money down, maybe under $1,000.
And that leverage magnifies your returns over time.
Hugely. Plus, unlike just owning a stock certificate, you're often getting two types of return, aren't you?
Right. The property value hopefully goes up, appreciation, but also rent.
Exactly. Cash flow from rent coming in, and hopefully long-term appreciation. Plus, you often get tax advantages like depreciation, which helps too.
But you can't just buy anything anywhere.
No, the sources are clear on this. Patience is key, which means buying quality properties. And crucially, in areas with that slow, steady, long-term growth, population growth, economic activity expanding, not just betting on a speculative hotspot that might fizzle out.
Okay. Then there's the really patient end of the spectrum. Commodities, natural resources, these sound like they need even more conviction.
Yeah, these can be volatile in the short term. Here, you really have to be thinking about those huge, almost unstoppable global mega trends.
Like what? Give me an example.
Okay, think about water rights. With population growth, climate change, water scarcity is just, it's a trend going in one direction over the next 50 years, right?
Yeah, sadly.
Or things like agricultural land, timber, maybe even the infrastructure for renewable energy, solar farms, wind turbines. These things have really long payback periods, sometimes 15, 20 years before they start generating solid returns. That requires true decade-level thinking.
So the common thread seems to be the best long-term investments often look a bit boring, maybe even risky quarter to quarter. They definitely avoid that get-rich-quick hype.
That sums it up well.
But if the math is so clear and the assets are identifiable, why is this so hard? Why do so many people fail at it?
Well, this is fascinating. The biggest barrier, it isn't the market, it isn't finding the assets, it's us, it's our own psychology.
We're wired wrong for this.
Pretty much. Humans just aren't naturally built to delay gratification for 30 years.
Yeah.
Evolutionarily, as you said, it's about immediate survival, right? Not planning for retirement decades down the line.
Makes sense.
And the sources point to a specific bias that trips us up constantly. Hyperbolic discounting.
Hyperbolic discounting. Okay, what's that?
It's our tendency to just dramatically overvalue rewards that are right in front of us compared to bigger rewards in the future.
Like hitting the snooze button.
Exactly. It's the financial version of that. You know your future self will regret it, but your present self just wants that immediate little bit of pleasure or relief.
So getting $100 today feels way better psychologically than the promise of maybe $300 in 20 years, even if the math works out.
Precisely. We trade that certainty, that immediate dopamine hit, for maximizing long-term growth. And it's even harder when you add social pressure.
How so?
Well, it's tough sticking to your boring index fund plan when your friends are bragging about some crypto coin that went to the moon or some meme stock windfall.
Yeah, steady Eddie investing doesn't make for great party chat.
Not usually, no. So you have to actively fight your own instincts.
Okay, so how do we fight? What are the practical strategies? How do we overcome this wiring?
It's number one. Absolutely crucial. Change how you measure progress. Stop looking at daily stock prices. Seriously, stop checking the investment app every hour.
Easier said than done for some.
It is hard. But try to shift your focus. Track your overall net worth, maybe just once a year. That pulls your attention away from the daily noise and back to the long-term signal.
Good advice. What else? We talked about future self-visualization.
Yes. Make that 20 or 30-year goal real. Don't just have a number in mind. Make it concrete. Make it emotionally compelling. What will having, say, $5 million actually let you do?
Start that business, quit the stressful job, travel.
Exactly. What specific freedom does it buy? Visualize that. That builds the emotional commitment you need to stick with it.
And automation must play a role here.
Hugely important. Set up automatic transfers into your investment accounts. Takes the emotion out of it completely.
Removes the friction.
Removes that psychological friction of having to decide to invest each month. You just do it, regardless of whether the market feels good or bad.
Okay, and here's one that sounds completely backwards, but makes sense for a decade thinker. Embrace volatility. See it as a feature.
Yes. This is counterintuitive but vital. If you're investing regularly, automatically, then market downturns aren't disasters. They're sales. They're opportunities to buy more of those good long-term assets at lower prices.
That takes real psychological strength, though. Let's talk about a decade winner like Berkshire Hathaway to see that strength in action.
Perfect example. Since, 1995? Over 800% returns.
Incredible.
But to get that return, you had to hold through long stretches where the stock did basically nothing,
Right.
flat, or even declined for years at a time.
Imagine that, going years feeling like you're going backwards or sideways.
It's the absolute opposite of a thrilling ride. It's like a long, slow train journey, as you said.
Yeah.
Their success wasn't about picking the next explosive tech stock. It was about building and owning stable, solid businesses, insurance, railroads, consumer brands people need, things with those sustainable moats.
And the ultimate boring but essential example, waste management.
Yes. Doesn't get much less glamorous than that, does it?
Nope.
But think about the structural trend. Populations grow, economies develop, we produce more waste. It's inevitable. Managing that waste becomes more complex, more regulated.
It's an essential service.
It's basically a utility that benefits from a decades-long, undeniable trend. Doesn't matter what the S&P does next week, people still need their trash collected.
Okay, so we get the mindset, we see the kinds of assets. How should someone actually structure a portfolio for this? The sources mention a 3-bucket framework. What's that?
Yeah, it's a pretty sensible way to balance things. Bucket 1 is your foundation, maybe 60% of the portfolio.
The core holding.
Exactly. Broadly diversified. Captures overall economic growth. Think index funds, like an S&P 500 tracker or a total world stock index. This is your ballast. It ensures you participate in general wealth creation.
Okay, 60% foundation. Then bucket 2, structural growth, about 30%.
Right. This part is more targeted. It holds investments benefiting from those specific long-term macro trends we talked about, like healthcare tech for Asian populations, maybe. Or companies enabling digital transformation or infrastructure for clean energy. These are areas driven by pretty predictable demographic or technological shifts, higher conviction than the broad market.
Got it. Which leaves bucket 3, high conviction bets, the last 10%.
Yeah, this is where you get more concentrated. Maybe individual stocks you've researched deeply, specific real estate deals, perhaps some private equity if you have access. These are things you believe will significantly outperform over a decade or more. Requires the most research and the most patience.
And across all these buckets, especially with a 30-year view, international diversification seems non-negotiable. The U.S. killed it the last decade, but that won't last forever.
Absolutely vital. You cannot just stay in your home country if you're thinking truly long-term. History shows leadership rotates.
So where should we look globally?
Well, beyond the developed markets like the U.S. and Europe, you have to consider the structural growth stories. Think about India. Huge young population, urbanizing fast. Southeast Asia, places like Vietnam, Indonesia, massive potential there.
And even developed markets outside the U.S.
Sure. Japan still has incredible tech capabilities.
Yeah.
Europe leads in areas like luxury goods, pharmaceuticals. You need that global mix to smooth out the ride and capture opportunities wherever they arise over the next few decades.
Okay, strategy, assets, structure. Let's talk pitfalls. What are the big mistakes that wreck this whole decade thinking approach?
Oh, the number one killer, hands down, is starting with the right idea and then just abandoning ship at the worst possible moment. Panic selling.
Selling during that first big downturn.
Exactly, like in 2008 or the COVID crash in 2020. You lock in your losses and you miss the recovery, which is often sharp. Decade thinking gets its toughest test when the headlines are screaming sell.
And the opposite, maybe. Trying to be too clever, timing the market.
Yeah, that's another classic. People say they're long-term investors, but then they sit on cash, waiting for the perfect entry point.
Which never quite arrives when you expect it.
Almost never. Time in the market, especially over decades, just consistently beats trying to time the market. Another big one, concentration risk.
Putting too much in one thing. Even a good thing.
Even a great company. Technology changes, competition emerges. Think about the giants that fell. Kodak, Blockbuster.
Yeah.
Even GE had a rough time. Diversification protects you from those unforeseen collapses over a 30-year period.
And one more, the quiet one. Lifestyle inflation creep.
Ah, yes.
Yeah.
The silent killer of compounding. As your income goes up over the years, you just spend more, bigger house, nicer car, more expensive holidays.
Instead of investing the difference.
Instead of dramatically scaling up your investment rate, you basically rob your future, much wealthier self to pay for a slightly nicer present.
Okay, looking forward now. Applying this decade thinking to the trends shaping our future. What should be on our radar?
Well, artificial intelligence is obviously huge. But the sources say don't just bet on one AI stock. Think broader. How does AI transform entire industries?
Like logistics, manufacturing, drug discovery.
Exactly. Invest in the companies using AI to become way more productive, or the infrastructure enabling it all. It's about the application over decades.
Makes sense. Healthcare technology also feels like a massive, unstoppable wave.
Driven by demographics, right? Aging populations globally. So things like gene therapy, personalized medicine, biotech advances, these could fundamentally change health and lifespans over the next 20, 30 years. Huge investment implications.
And we can't ignore climate change.
Definitely not. Both risk and opportunity there. Investing in companies adapting to climate change or providing the solutions, renewables, efficiency tech, new materials, and also, crucially, avoiding assets that might become stranded things tied to old carbon-heavy ways of doing business.
And underlying all of this again is demographics.
It's such a powerful, predictable force. Aging populations in rich countries needing different services. Urbanization and a growing middle class in emerging markets demanding more goods, infrastructure, energy. These trends play out over decades, making them perfect for this kind of thinking.
So for someone listening now wanting to start, what are the first steps?
Okay, first, just audit your own mindset, honestly. How often are you checking your portfolio? Then, set those really specific 20, 30-year goals. Make them compelling. Visualize them. And then, the practical bit. Automate your investing. Set up those regular transfers, remove the emotion.
And maybe educate yourself more. The sources mention specific thinkers.
Right. Reading foundational stuff helps embed the mindset. People like Seth Klarman, Joel Greenblatt. Understanding valuation, understanding business quality, that helps you ignore the noise.
Okay, great actionable steps. As we wrap up, what's the final takeaway?
I think it's this. Decade thinking isn't just a different way to invest money. It's really a different way to think about creating wealth, maybe even about life. The most successful investors, often not the smartest, not the luckiest, they were the ones who found good assets and just had the sheer patience to hold on through everything.
Right, through multiple market cycles, good times and bad. And here's a final thought to leave you with. What if adopting this long-term view actually makes you perform better even in shorter periods?
How so?
Because by taking your focus off the daily panic and noise, you're calmer. You make more rational decisions, especially during crises, which are often the times when the biggest mistakes or best opportunities happen.
That's a great point. That compounded effect. It's psychological too, isn't it? The patience you build managing investments. That discipline spills over. It can lead to better decisions everywhere, less stress, genuine financial freedom, and that kind of outcome. Well, that's definitely worth waiting for.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.